Hello everyone, welcome to my YouTube channel and welcome to the weekend update analysis video. So let's talk about the markets. You see that the title of this video is Surprising Resilience that comes with optimistic caution and with a question that will the markets keep grinding higher slowly and steadily. So let me actually break down this title and exactly explain what I mean over here. Now, surprising resilience is because, as you can see on Friday's session, we had a really nice comeback and we really negated a stronger part of selling that happened on Thursday. But then, what does it mean for the markets going forward? I see, in my personal opinion, I don't see a major, breakdown of the markets more than 8 to 10%. Even in case if we go down, there is a very high chance that next week there is a chance that we may test the 50-day moving average. But what I'm saying over here is we need to be very, very cautious going into next week. And then eventually, my thesis is we have at the most 8 to 10% correction and then we start grinding higher. So that is the meaning of the title. And now let me discuss and show you why I say this and with the evidence of both the fundamentals and the technicals. So without further ado, let's jump on right into the analysis. I'll start with the macroeconomic section first. In this macroeconomic section, let me break down point by point what happened last week and what are the implications of those events going into the next week. So on Wednesday, we had a speech from Fed Chair Powell at the Stanford, University, and he reaffirmed the resolve of Federal Reserve to bring the inflation down to 2%. And then he also had a Q&A session wherein he reaffirmed that Federal Reserve is not a political organization and it is not affected by, any means from the Capitol Hill or the president. So that is apolitical, that is non-political, affirmation from Federal Reserve. Since this is an election year, there is a lot of pressure on, Fed Chair Powell and Federal Reserve itself, asking questions that, they can be manipulated by, the existing ruling president and whatnot. So that was reaffirmed by Federal Reserve and he is steadfast on his, mandate that he is looking at only two important things. What is the inflation doing and what is the unemployment doing? So the best case scenario for Federal Reserve is they engineer a soft landing, and apparently due to the stronger economic data, due to stronger unemployment numbers and the non-farm payrolls coming in so hot on Friday, it looks like Fed is going to engineer a soft landing. So we'll have to see and we'll have to wait and watch how it goes through. But if this happens, if Fed is able to engineer a soft landing, then this would be the first time in the history that Federal Reserve was successfully able to achieve soft landing. But we'll have to wait and watch, and we'll have to continue monitoring the incoming data and see what's going on. The interesting part about this week was on Wednesday there was the Powell speech, and at that time market did not spook. But on Thursday, some other Fed speakers from Richmond and Minneapolis stated that we may not see any rate cuts this year. That's in the realm of possibilities, and that spooked the markets. So we had a very sharp sell-off on Thursday, and this comes, this was very shocking. Why? Because on Wednesday, Powell affirmed that he is seeing at least one rate cut this year. So he did not mention like by how many basis points he's going to cut, but what he's saying is he is thinking that he may cut at least once this year. So apparently among the Federal Reserve Chairman Jerome Powell and the other Fed speakers who are presumably non-voting member like Neil Kashkari, there's a lot of confusion in the markets, and that is exactly the reason why there is a lot of volatility into the markets. So remember, markets love stability, and any signs of confusion or instability may fuel the volatility into the markets. So that is what happened this week. Wednesday we were stable, Thursday we had a very sharp sell-off, and Friday we had a very bolstering, very nice recovery. So apparently the volatility is high, but if you look at the scoreboard, if you look at the final results, we are not like very, very surprisingly down. We are almost 2.5 to 3% down from the all-time highs, which is fairly normal. Now, let's move to the Middle East tensions. So on Wednesday, on this week, Israel bombed, or let's say did a missile strike on the embassy of Iran in Damascus, which happens to be in the Syria region. So that was a shock to the markets. Why? Because if Israel attacks the embassy of Iran, then definitely Iran is going to respond with some form of retaliation. Now, any signs of escalation of war into the Middle East will make crude oil even much higher. So the cost of crude oil is anyways going up more than or north of $85 a barrel, and such signs of any escalation in the Middle East will propel crude oil even more higher. So that is why the commodities like gold, like crude oil, are shooting up because of the instability in the Middle East. So that is also one of the reasons why the markets had a huge volatility this week. We never know, how long and how deep is going to be, two wars turning out. One is the Russia-Ukraine war, and the other is the Israel and Hamas war. So until and unless those wars are contained, until and unless there is a peace deal, brokered between those nations, you will see time to time these volatilities, small shocks coming into the markets and increasing the volatility. So that is from the macroeconomic front. We are continuing to see stronger job numbers. We are continuing to see unemployment rate below 4%. So economy on paper is doing good, is doing strong. So Fed right now has a very little incentive to cut the rates. At the start of the year, markets and people were pricing in almost 6 to 7 rate cuts. Now we are pricing in 1 to 3 rate cuts. So there is a lot of instability. On top of it, we have an election year. So we'll have to see what's going on. But so far, right now, markets are in a very healthy, territory. We have seen almost, 5% pullback, 4.8% from the all-time highs in the Thursday's, sell-off. So let's see how it turns on. But my thesis is at the most we will see not more than 8 to 10% correction, and which would be a very good buying opportunity given that we are not in a seasonally weak period. So remember, in the entire year, May and September are supposed to be seasonally weak periods. So if we get a really good correction in those months, then that would be a really good buying opportunity. So since this is April, I'm not expecting more than 6 to 8% pullback in the markets. So that's my take from the macroeconomic front. And now let us jump on to the weekly time frame to study and see what are the technicals saying about the current market price action. In the weekly time frame, as always, I'm going to discuss the support levels, the resistance levels, and the key takeaway from the weekly charts. So let me show you all of this into the weekly charts. So as you can see, this is the weekly charts. And in this weekly chart, there are two important things that we can observe. The first clear thing is the resistance, and that resistance right now is sitting at 18,500 to 18,600 levels. And why do I say this? It is because the 1.272 level on the Fibonacci ratio is apparently acting as a very nice resistance zone on the weekly time frame. So as you can see over here, if I point it out, this zone is acting as a really nice resistance since past 1, 2, 3, 4, 5 weeks. So this is the resistance zone. Now if I talk about the support zone, then the prior resistance will act as a support, and that is exactly what is happening. So if I bring my highlighter over here, as you can see, this was acting as a prior resistance and now it is acting as a support. So if I extend this line, you can see that since past 1, 2 and 3 weeks, we have tested this support line, and we have also, this acted as a support. So if I talk about the actual levels, and if I point it out in the levels format, then 18,000 level is going to be a psychological support as well. And also it has acted as a support since last 6 weeks. So what do I mean over here going forward? If we retrace back, or if we have a really nice chance to test the 50-day moving average, then the actual area of support is going to be this one. And why am I saying this? The green box that I have drawn over here corresponds to the point of contact in terms of volumes in all the 3 candles over here. So as you can see, the majority of volume has taken place over here. So that is going to act as a good support zone. So to give you the actual levels, 17,850 is going to be a really good support zone starting, and then the ending of that is 17,720. So this is going to be a really good support in terms of weekly time frame. And in terms of resistance, the resistance is sitting around 18,500 to 18,600 levels. So that is the resistance end. Now what we can see from the weekly time frame is we have taken our time, the markets have taken their time to actually consolidate into this range a lot. There's a very small possibility that we may see more breakdown than this green box. So we'll have to see and watch, but the weekly time frame remains in line with the expectations, a stable uptrend, a steady uptrend, I would say. Look at what happened last time as well. We consolidated in one zone and then we started rallying higher. So if we see a larger and a longer consolidation, that is only a sign of good, healthy, digestion. So that's my take on the weekly time frame. The support level still sits around 18,000 and 17,800 levels, and the resistance sits around 18,500 to 18,600 levels on the NASDAQ futures contract. So now let us go to the daily time frame. In daily, technical analysis, I really love the daily time frame, and let me tell you why. It gives us a very detailed, zoomed in market action and very actionable insights. So let me share you all of those insights in the charts, discussing the support and resistance levels and discussing the very key important zones moving forward. So if I go to my technical charts, this is the daily charts. And in this daily charts, the first thing that I want to discuss is the support zone and the resistance zone. So I have drawn this red box as a resistance zone. And let me tell you why. Because this zone has acted as a resistance for so many daily candles and so many daily closes. So as you can see over here, we have made a very big wicks over here, also over here, and also latest over here on Thursday. We got rejected several times on daily time frame from this zone. So there is no question that this zone is a very strong resistance in the daily time frame. And if you come down to the support, there is no question that we have holded this green zone as a support for so many days. So as you can see in the last pullback that we had back in the mid of the March, we nicely holded this zone. And also in this week on Thursday and Friday, even after all the non-farm payroll data release, we holded this zone very strongly. Now, you know that you have a definitive line in the sand that if this zone gets broken, only then markets can go lower. So now it makes our job very easier. Why? Because next week we have a market moving event, that is the release of CPI data. Now, if that CPI data comes in hotter than expected, which I surely recommend that it will. Why? Because there is a lot of higher crude oil prices, which will result into the higher CPI numbers, that is consumer price inflation numbers. Now if that comes in very, very hot, then there is a very strong possibility that we test the 50-day moving average, that is the cream, or let's say darker yellow line that you can see over here, and that also corresponds with the S1 level on the daily time frame, that is traditional pivot levels. So keep a close eye on this support zone. Markets can only go lower if it violates or if it breaks down below this. So this is an important zone or an important low to watch moving forward for the next week. If we close, any close below this level is going to be very, very bad for the markets. So if we close below this week, then the first level of support is going to be this pivot level, this 50-day moving average, which corresponds to both, and then the lower end of the Bollinger Band. So if you see over here, I discussed the zones, and now let me give you an actual statistics that if we break down, then what is the percentage that we will break down. So if you can see over here, if I draw a ruling scale from the all-time highs to the 50-day moving average, then that would be of 3.9% drawdown. And if I draw a 5% drawdown, then it would be somewhere over here. So a 5% pullback is going to be very, very healthy and very, very nice in terms of buying opportunity for the markets, given that the strength we had in this year. So just to make things clear, a 5% pullback in the markets is very, very healthy, and I would most welcome that to get a good buying opportunity. So this is where we stand right now. We are right now at almost 2% pullback, which is nothing, right? So so one key takeaway from the daily time frame is there is a very high chance that we test the 50-day moving average on Wednesday, because on Wednesday pre-market hours we have a CPI data release. That is first. Second, I wanted to discuss the technical analysis is all about recognizing the trend. So the way I do it is I use moving averages. So for me, the gauge of the short-term sentiment or the short-term trend is the 5-day EMA. And for me, the gauge of the long-term trend or a long-term sentiment is 26-day EMA. So as you can see in the charts, the blue line that you can see is the 5-day EMA, and the red line that you see is the 26-day EMA. Now, in any case, on Wednesday's close next week, if this blue line crosses this red line from above, then that in technical terms is called as bearish crossover. So if if we get a bearish crossover next week, then expect a lot of downside to come. Now I'll also discuss how much downside you can expect in the following sections of this video in the anchored VWAP section. So what I think and what I based on my experience, the most we can go down is from the all-time high levels, that is this level, that is 5%. That is the healthy pullback. So we'll have to see and we'll have to wait and watch. But now we have a definitive line in the sand. Below this level, we have to be bearish, and above this level, we have to be bullish. Anything in between these two zones is pure noise. So just wait for the confirmation, just wait for the markets to break out either on the bullish side or on the bearish side, so that you can have a very good data-backed decision and data-backed trade. So that's my take on the daily time frame. We are very close to the bearish crossover, and we are very close to testing the 50-day moving average going into the next week. So that's my take on the daily time frame. And now let's jump on to the next section of anchored VWAPs, where I show you the exact levels of the depth of the correction if the correction happens next week. So let's go to the anchored VWAP section. So many people ask me that why do I use anchored VWAP into my technical analysis, and what is the significance as opposed to the traditional indicators that many other people use. So this is the perfect week to showcase like where the anchored VWAP shines as opposed to the different other indicators. And let me show you that in the daily time frame. So if I go to my anchored VWAP charts, the first, for all of those who are new to anchored VWAP world, let me tell you the significant mounting points of those anchored VWAPs. So I have mounted this pink line, that is the anchored VWAP from the FOMC meeting of January. You can also see the green line, that is the anchored VWAP mounted on the Nvidia earnings. And then you can see the anchored VWAP that are mounted on the latest FOMC meeting and the most recent high. Now, what do I mean when I say where the anchored VWAP shines? So as you can see over here, the pink line corresponds to the FOMC January mounting point. And you can see that this week, both Thursday and Friday, it holded this line as a support, and it exactly stopped going down at that line. So this line corresponds to the anchored VWAP from the FOMC January. Now, why is this important? So let me show you the traditional, daily chart with the traditional indicators like moving averages. So if you, delete this zone, you can see that there is no support level that was evident from the traditional indicators, on the daily chart. No significant moving averages were in this zone that could have told us that, okay, from this zone, you can expect a support. It was only the anchored VWAP that was showing us support. And guess what? The price action respected the anchored VWAP indicator. It did not respect, the 26-day EMA. It did not respect the 50-day EMA because it didn't even touch it. So that is why, to get the hidden support and resistance levels, to get the hidden, price action which respects those levels, I, tend to, consider the anchored VWAP into my analysis to actually see where, the resistance and support zones are. Because you can see over here, the price action respects and behaves much more reliably on the anchored VWAP as opposed to the traditional, indicators in technical analysis. So that's the power of, anchored VWAPs. And that is why I wanted to show you in real time. This is the exact perfect week to show why the anchored VWAPs are so significant. Now, let me go into the meat of the game. The reason why I show the anchored VWAPs in this section is because if the markets decide to go down, then this is going to be a definitive line in the sand for the support. So as you can see, next week we have the CPI data release, and over there, if the markets decides to go down, then the level that is 17,765 or 17,800 levels are going to be acting as a very strong support. And why do I say this? It is because this red line that you see over here is the year-to-date anchored VWAP, and this year-to-date anchored VWAP has been, significantly acting as a support over here, and there is a very high chance that it acts as a support over here as well. So in the Nvidia earnings, we can see that it acted as a really good support over here as well. At the start of the year on January 17th, it acted as a very nice support. So the year-to-date anchored VWAP, that is this red line, would be a critical zone to watch moving forward. So many people ask that, okay, correction will happen, okay, markets will go down, but how do I say quantifiably that how much it is expected to go down? So this is a very good tool, or this is a very good indicator based on price and volume to actually gauge like how much the depth of the markets will be. Now obviously there is a very high probability, but nobody can be 100% sure, but these kind of tools helps us determine with a good risk to reward ratio as to how much it can go. So it's all about higher probabilities. It's not about being right exactly, but it's all about minimizing the risk and maximizing the probability on your side. So that is why in trading I use this anchored VWAP, and that is why going into next week 17,800 level is going to be very, very crucial if the markets decide to pull back. So that's it from my side from the anchored VWAP section. Now let's go to the next section, which is economic events on next week. So the economic calendar has only 2 to 3 important events next week, and that event is the CPI data release on the Wednesday. So Monday and Tuesday are going to be relatively stable and relatively quiet. So expect a lot of sideways actions on Monday and Tuesday. On Wednesday, you can expect a lot of increase in the volatility and a lot of range expansion. And the very reason why is because on Wednesday, there is a CPI data release, that is consumer price inflation data release, which is, expected to be around 3%. And on Thursday, we will have the PPI data release, that is producer price index, that the Fed uses to gauge the inflation. So those 2 days, Wednesday and Thursday, are going to be really critical for the markets moving forward. And then Friday, we have, Michigan consumer sentiment data release, which is fairly stable, which will not have a very big impact as compared to the inflation data releases on Wednesday and Thursday. So my game plan going into next week is very, very simple. Trade on Monday and Tuesday as usual. On Wednesday and Thursday, be extra cautious and keep a close eye on the range and the zones that I have told in the previous section of this video. And on Friday, once those range confirmation happens, then we will be in a better position to decide what is the next course of the market. So my game plan going into this week is I'll just keep a close eye on the VWAP levels that I have told you, and any dip which is more than 5% or which is more than 8% is going to be a significant buying opportunity. So keep a close eye on those levels and keep a close eye on these events, especially the scheduling, that is Wednesday and Thursday, so that you can decrease your position size and increase your risk management so that you can have an informed decision and you can be a better trader. So that's my take and regarding the insights from the economic calendar next week. So yeah, brace for the impact and learn from all these events and learn the correlation of price action with the events, that is macroeconomic data. So that's my take on the macroeconomic front. So lastly, I would like to thank you for watching, and please feel free to like, share and subscribe if you find value in this video. So there is a lot of learning that you can have and you can do, and there is a lot of opinions and challenging your existing analytical thesis that goes on. So if you find value, please feel free to like, share and subscribe so that YouTube algorithm promotes these kind of videos and we can have diversity in opinion and we can learn from each other. So thank you for watching, and I would like to end this video over here.